Okay, folks, welcome to Monday Night Futures Live. If you're not currently a subscriber, please make sure to hit that notification bell and get notified of when we go live, typically on Sunday nights. But obviously, today being Labor Day, we extended it out until Monday night. So I kind of regret not doing it last night, meaning the live stream, due to the fact that we had some pretty significant price action in the metals market: gold, silver, platinum, palladium. Some really big moves there. In fact, gold hit all-time highs overnight. We're going to talk about the whys behind that. And is there still room to run to the upside for gold, for silver, platinum, palladium? But first, let's kick it off with talking about the E-minis. Let's drill down to a 5-minute view to get a vibe for the price action here. It's still a holiday. It's going to be light price action. I'm just watching to see how things settle down here for a minute. We only have a few people on, so I want to I'm going to be deliberately slow here in going over these symbols. I didn't bring my water down. God damn it. All right. Okay. So not much volume here at all. Let's take a look at the NASDAQ 100. NASDAQ 100 opening up 0.15%. We're going to be talking about seasonality in a while, because the month of September is typically not a good one for the equities markets, and that really comes into play when you appreciate the fact that you have inflation on the rise, pressure on the jobs market, and valuations that are just through the roof. And on certain levels, they are at all-time record highs in terms of valuations. I'm going to pause here. Again, I want to let these futures settle down. I want to let people get in here. Let's say hello to folks. Look at Jody, right on time. Very, very impressive. Happy Labor Day to you too. Larry, welcome. Yeah, no doubt. No doubt. The pool's getting colder and colder. I'm still jumping in there. It's good for the inflammation. I'm treating the pool as a therapy session now, not so much enjoyment, but as therapy. You ever see those people that get into the ice buckets or the ice baths? That's me right now. Mr. Sean, hey, brother. TF Hatter, watching the bond markets. We're going to be talking about yields in a moment. Welcome. Yes, please hit the like button. Thanks, TF. Appreciate that. Well, welcome to you. All right, let's get to it. So we still have the NQ positive off of its highs. Let's take a look at the small caps. Small caps have been doing really well. They traditionally outperform the larger cap names in a declining interest rate environment, meaning a Fed rate cut regime. That certainly didn't happen in September of last year. They lagged the overall markets. And the question is, do we get longer term yields that drop along with the short term yields? I don't see it. I don't see it happening. Maybe it does. But we're going to be talking about a chart from the Mortgage Bankers Association, and they are not predicting measurably lower mortgage rates for the next year and a half, 2 years. So Russell 2000 about flat. All indices thus far are positive. EMD, the mid caps, up. All right, so an up market, bias long, not much happening here. Let's turn our attention to the dollar. because here's a 4-hour review. Because I'm of the impression that the powers that be are going to sacrifice the US dollar to try to pay back our debt with dollars that are just not equal to the value at which we borrowed. They're going to inflate away our debt. And unfortunately, that's not good for Main Street. It's very, very bad for Main Street. And it's not going to be good for equities. So here's your downtrend channel on the US dollar. I set up an alert to see whether or not we break below the lows of today. This is a pretty bullish reversal. Initially, they took us down. Then we had this big 4-hour reversal bar. So clearly we have some support. The question is, do we get follow through? And I'm sure this is on very, very light volume. All right, now that we know what the dollar is doing, dollar down at the open, let's take a look at the precious metal markets. This is the area that has been in the news. And wow, we have gold opening up nearly a percentage point. Folks, I can tell you right now, this is going higher. We're off the highs of last night. But I think that by this time tomorrow, we will have taken it out. I could have sworn I hit above, but let me try that again. Single above. Okay, good. Maybe it was my fault. So gold here at the open looking very strong. Continuation move. Silver, 11-year highs for silver. It just wants to go up. This wants to go up. Silver up 2.41% at the open here. Going to set up an alert to see if we get a continuation move higher. I think that we will. Probably before we sign off tonight. Palladium, of which we are long. We're long of silver. We're long of gold. We're long of palladium. I've been wanting to buy more palladium, and I just haven't done it after this big, big pullback. But I got to get off my you-know-what and pull the trigger here. So we have palladium up at the open here by 4%. What's the symbol for platinum? PL? Yeah. Wow. Platinum up 4.09%. I don't have a position here in platinum. Let's check in with the energy markets. Oil had a very good week last week. Let's go to the weekly chart. So the week of the 18th, we saw a bullish reversal bar, one of my favorite candlestick formations. And last week, we broke out on light sweet crude. And this week, it appears as though they're going to try to make a go for new higher highs on oil. Right now, it's coming in a little bit. But we're swing traders here and investors. We're not day traders. I really don't care per se what the 5-minute chart tells me. I care more about the growing base, the growing consolidation on the weekly time frame, and then the follow through on a daily and a 4-hour time frame. So still growing more and more bullish here on oil. Now, last week we reinitiated a position on natural gas right at the lows. We saw that the 4-hour chart, the 30-minute chart were all putting in higher lows, and we were just waiting for the daily follow through. So we jumped in front of that daily follow through. We called it right, and we're now long of natural gas yet again. I guess we got in. When do we get back in here? Let's go to the 4-hour chart. Right here. Right here. Higher lows. Right here. This is what we were looking for. Higher lows, breakout, and then the move up higher. So I'm still liking natural gas. We're going to be talking a little while about commodities in general and how last week the CRB commodity index, which is just a basket of all commodities, that broke out, and it broke out very, very decisively. So we have inflation as measured by commodities, which I don't know much better measure of inflation. You can't hide the inflation. The Fed could lie about it. The government could lie about it. But when you see the commodities basket breaking out and getting ready to move higher, well, you could be a safe bet that you're going to see a weaker U.S. dollar and probably gold and silver prices moving up higher, which is exactly what's happening right this very moment. The question is, do stocks hold up in that environment? Now, we are building a short position, and so it's obvious that my thought process here is no. Let's take a look at, I want to take a look at agriculture. Wow. Big gap up high here on the week for wheat. Is this week or is this last week? This is last week. So this is not reflective of any price action thus far this week on wheat. I'm surprised at that. Maybe the wheat markets are closed down today. I don't know. But the price action here from last week was very, very bullish. ZC, corn, bullish as well. 3 back-to-back up weeks. And I guess you could argue, no, it's not an argument. It's a fact. We broke out. Oh, this is beautiful. Actually, a beautiful setup here. And this is what I always like to talk about in terms of getting your breakout, getting a retest, then getting follow through to a new higher high versus the prior breakout point high. So corn looking very good here, bullish. ZS. This is last week. Yes, last week. So soybeans closed above their 21-period EMA in orange. It did so back here on the 11th, retest number 1, retest number 2 last week. I think we're getting follow through. I think we're going to see prices rise on agriculture. The question is now, what is protein doing? What is live cattle doing right now? Are we seeing protein prices rise? Well, you could bet your bottom dollar we are, because cattle is at all-time record highs. So you have agriculture breaking out of weekly bottoms. You have cattle at all-time record highs. This is going to stay this way at least until 2026, because right now you have the number of livestock, the head of livestock here in the United States is the same as it was back in the mid-1960s. And our population's what, 30% more, 40% more? I'm just throwing numbers out there. But that's an astonishing fact that we have cattle head at highs or at levels not seen since 1965 with a much bigger population, and it's being expressed in price. The markets never lie. Now, this is going to go into a bear market at some point in time, just as lumber did. Nobody thought lumber was going to come back to earth, but it did. What am I missing here? I'm missing something. Let me scroll. Bitcoin. All right, so over the weekend, Bitcoin did not have a great week end, and we are opening up lower here. Back down, flirting with that $100,000 per coin mark. XRP. XRP very weak, down 3.27% at current. So these risk assets are under a lot of pressure. Here's the weekly view of XRP. So it looks as though we're probably going to make lower lows here on XRP. What did I miss? I think I did it all. I believe I did it. Let's just take a look at gasoline prices, because everybody can appreciate when gasoline prices go up because it's right in your face every time you drive down the road. I just saw it. Where is it? RBOB. So let's go to the weekly view here. At current at the open, you have gasoline prices rising 1.15%. Weekly view, not a bullish chart. Thank God, right? We don't want it to go up. But we are right down at the lows of a shallow downtrend channel. Last week was not a good week. I mean, really took it on the chin. Gasoline prices, for whatever reason, you would think that they would trade in tandem with light sweet crude. Not last week. All right. Let's go back to comments. Quiet night tonight. Yep. Silver looking really good. Yep. Lee Cable. No worries, my friend. Enjoy that vacation. Michael Anthony, welcome. Denny, welcome, my friend. Okay. Let's get to the events that are going to be occurring this week, whether we like them or not. Let's begin with the economic data. Obviously, today, I can't believe I forgot my water. The markets were closed, so no economic data tomorrow, though. We're going to get the S&P final U.S. manufacturing PMI. That's a purchasing managers index. 10 a.m., we get the ISM manufacturing numbers and construction spending. Pretty important number. Doesn't get enough attention. They're expecting a flat number there. Remember, construction has a ripple effect throughout the entire economy. Wednesday, job openings. Folks, this is going to be very, very important. Factory orders, they're expecting a negative read there. The Fed Beige Book, Thursday. Oh boy, this is a jobs week. It's going to be all about jobs this week, folks. We get the ADP employment report that comes out on Thursday. Normally that would come out on Wednesday, but they did a push here due to the holiday. ISM services, trade deficit, that might actually be interesting. They're expecting a decline. Second decline. Well, Friday, it's all about the pimp Mac daddy of them all. Let's face it. Let's just sum it up into one thing here this week. It's going to be about non-farm payrolls, folks. It's all about jobs, and you gotta keep an eye on the FedWatch tool, because if jobs numbers come in weak, well, they're only expecting 10% of the respondents to the FedWatch tool are only expecting a quarter basis point cut. If we get a weak jobs number, this is going to rise. The problem for the Fed, the problem for the government, the problem for you and me is that Gold is going to rip. Tips are going to rip up higher. Silver is going to rip up higher. The CRB commodity index is going to rip up higher. Why? Because the more that they cut, the greater the impact on inflation. And it'll just make it all the more clear that we have a stagflationary environment, very similar to what we saw back in the 1970s. And you know, the Atlanta Federal Reserve came out recently, and they're expecting a 3% GDP. So I've never heard before where you have the Federal Reserve with 3% GDP, with rising inflation nowhere near their target, yet they're going to cut rates. And if jobs come in weak, they're going to cut them probably minimum by a half basis point. So we live in really interesting times at this right now. Love spending time with wife and kids. Beach time. Nice. Which beach? And even ride across the countryside on steam locomotive. Very, very nice. Very, very nice. Good for you. Sounds like a great trip. Enjoy it. Now, one of the divergences, and this is what we always look at for as traders, we're always looking for the edge. You know, what edge do we have over other traders, especially if we're going to put on an options trade or a short trade, either shorting the stock or using options to put that negative bet on. And one of those divergences is this. It's clear, it's defined, and is that you have the S&P 500 in red, which is obviously at nosebleed levels at this point, yet you have the number of private job openings, which are in decline, a real severe downtrend here. And this is not something we've seen in the past. And if you're wondering why this could be happening, it all has to do with M2 money supply and the fact you have a couple of other reasons. You have, yes, a lot of liquidity in the markets. You have a lot of passive investing, a lot of people just dumping money into their 401ks, keeping the stock market higher, and the promise of Fed rate cuts, as well as the retail investor in there thinking that they're missing the boat here and they want to get in on the party. You know, we've seen this before, and it doesn't end well. So this divergence at some point in time is going to have to come back down to earth. I think that the S&P is going to have to correct first, so that the Federal Reserve has more of a reason to cut more aggressively. And then ultimately what they're going to do is they're going to buy back their own debt. They're going to monetize the debt, and they're going to have to go a lot bigger than they have in the past. So before we get higher on the S&P 500, I think we need to take a measurable step back. Now, in terms of earnings coming out this week, not a lot. Really, on Wednesday, you get some retail, Macy's, Dollar Tree, but Salesforce.com, Hewlett Packard, other than them, you get Broadcom after the bell on Thursday, and Lululemon, DocuSign's a little mid-cap stock. Other than that, not much to report on the earnings front this week. So really, earnings are now on the back burner. NVIDIA's already reported. They did not respond well, and now it's all about economic data yet again. And when we take a look at the Schiller PE multiple, we're at the second highest levels since the dot-com bubble. So, it's a very expensive market. And if you want more validation, that's an expensive market. The Buffett indicator, which is a measure of the U.S. total stock market, not the S&P 500. This is of the S&P 500. This is of the Wilshire 5000, the total composite of all stocks traded in the United States relative to the size of U.S. GDP. And we're at levels right now higher than the dot-com bubble. And the last view is an average of trailing PE, forward PE, the CAPE ratio, which is the Schiller, and a bunch of other metrics. And they're just averaging out where we're at in terms of valuation relative to history. And we're at all-time record highs as measured by this metric. What can go wrong? Uh, and we're going into a month that is seasonally unfavorable. We'll get to that in a moment. We're going to go over the performance of the S&P 500 and the triple Qs as we move into September and as we move into the new trading week. So as you all know, gold surging after last week's breakout, just shy of April's all-time high. We're above that now, I believe. Silver soars to an 11-year high. All the while, this is what I was just mentioning, September is the worst month for stocks. We should give an average here. Now, what I was talking about earlier, keep in mind, if you're wondering why is silver breaking out, why is gold breaking out, it's all quite very simple. It's this chart here. I mentioned it earlier. This is the CRB commodity index. It's just a simple view of inflation in real time. And last week we had a massive breakout above a resistance level, and we could quite possibly, especially if energy gets its act together, stabilizes and move up higher along with agriculture, they're going to take out this high here, 314.40. So how is agriculture doing going into the new trading week? The DBA agriculture ETF, and here's the weekly chart, and you can see that agriculture prices had their fourth back-to-back up week, flirting with all-time highs here. Let's make sure I'm accurate here. No, it's not all-time highs. 52-week highs. I'm glad I checked. But this is a very, very bullish chart. For agriculture. That's a textbook picture of a bull flag setup. Now, we already discussed cattle, but this is just another view of where we're at in terms of cattle prices. I mean, this goes all the way back to 2001, and very little has been done about this, especially under the Biden administration. I believe the current administration is putting pressure to get more cattle on the market, but this is absolutely preposterous. I mean, I usually go to Whole Foods on the weekend to do shopping for protein, whether I gotta look for sales on fish or red meat, and you don't see any sales. I haven't seen any sales at all in the past couple of weeks on red meat, beef, pork a little bit, but I'm not a big pork eater. And this makes for a good headline, but once you get the government into anything that's in the private sector, things only get worse. So I don't care who's president. I don't like the government involved in anything. So President Trump may declare a national housing affordability emergency, freeing up zoning laws, making exceptions on tariffs for building materials, et cetera, et cetera, et cetera. Here's the problem, and this is the cynical side of me, but that's the contrarian side of me, and that's that, if you do this, what you're going to do is that you're going to increase demand, and you're only going to add to inflationary pressures. So in the end, for employers to have to keep employees from shifting to other higher paying jobs, well, wages are going to have to go up. So we're into the baguettes. You start manipulating the housing market. It drives up the cost of housing as well as wages as well, because companies have to pay more to keep their talent. So a great headline. The problem is that it is inflationary. And lastly, I did a live stream a couple of weeks ago. I spoke about how the BRIC nations now make up of 52% of world GDP, and we are not a BRIC participant. 52% of the GDP of the globe is now the BRIC nations. And then you see something like this. The dollar is losing its reserve currency status. It's down to 42% of global reserves, and gold is rapidly rising. Is it any wonder why you are seeing the dollar I don't know what's going on there. There we go. The dollar is under a lot of pressure. We've broken this trend, and we are now putting in potential lower highs and lower lows. So not a good year thus far for the dollar. It's lost almost 7% of its value this year alone, and the year isn't over yet. And when you see the dollar decline, what does that do for prices for imports? They go up. That's inflationary. Lastly, despite all of the excitement of the fact that the Federal Reserve is going to be cutting rates, there's an element that is missing, and that's the fact that the short-term yields are dropping a lot faster than longer-term yields. Longer-term yields are in essence flat. The fact that shorter-term yields are dropping dramatically is sending the yield curve up. This is a monthly chart. This is now in the books. This is now fact. There's no changing this. The yield curve steepening. You saw a continuation breakout last month out of this bull flag setup. The yield curve is going to continue to steepen. And given that it's September and stocks, well, the S&P 500 traditionally does not do well with a steepening yield curve, you have a recipe for a potentially brutal month of September. Now, by the way, I didn't put this out there. If you folks have not entered your symbols, please head on over to the forum, Denny XRP. We could do that. Bonnie Bean, no, we have a bunch of people. Head on over. I'll give you the link if you want to sign up. It's free, no credit card required. It takes like 2 seconds. But you must enter your symbol here. That way I can track it. All right, so let's talk a little bit about seasonality. Now, seasonality will first begin S&P 500 with a 33-year view. September, it's only up 50% of the time. And when you take a look at it by week, it's up this coming week only 37% of the time. That's going back 19 years. So September is not a good month for the S&P 500. And by the way, we're using TrendSpider, 35% off. Use that discount code below, CON35, CON35. And I'll bet you they have a better deal because it's Labor Day. They give a I bet you that they're doing a big deal because it is Labor Day weekend. So head on over here. I'm going to post the link. Use this link. Head on over. They'll probably give you a better deal than my 35% off. Use that link. Take advantage of it. Let's confirm. Let's see. Yeah, they're doing 50% off. So take advantage of it, folks. Pretty good deal. Okay, let's move on over to the triple Qs. Now, the triple Qs on a weekly time frame are up only 42% of the time this coming week. And on a monthly view, it's not the worst month out of the year for the triple Qs. February actually is, going back 27 years. But it's still relatively a weak month for the triple Qs. So be very wary going into this trading week, especially with all of the big economic data that is coming out that could really roil the market. So be careful. Let's do some chart requests. Let me bring this over here. Let's go to comments first. Hi, Bob. Checking in late from Florida. Hey, Scott. Welcome. Thinking UNH could fill the gap to 342 soon. Yeah, I did a blog post on UNH earlier today. Let me paste that in. I'm going to try to do more blog posts. And there's a link to, I have some price targets on there for UNH stock. Okay. Where is it? What do I do? I close out the screen. We are going to go with, we'll do XRP first. XRP. Just curious about lumber. Yeah, look at that big bear flag. So, holy cow on lumber. Look what it did last month. You have construction spending coming out this coming week. You need lumber, and lumber prices are just crashing right now. This is a monthly chart, folks. Look at what we did last month. Holy cow, we broke. This is a bear flag setup that's followed through to the downside. Very, very bearish price action on lumber prices. Let's get back to business on XRP. I have an annotated chart that I have set up here for XRP, so just bear with me while I find it. Okay. All right. So XRP is obviously under a lot of trouble for transparency purposes. We own XRP. I just initiated a position a couple of weeks ago. And we are at critical support right now on XRP. We retested it a few weeks ago. I don't really like this setup at all, to be honest. We had retested the breakout point the week of July the 28th. Now we're back down there. I don't like that at all. We've already retested. We should have follow-throughs now. So we got to look to see whether or not it holds this 2.66 mark. Our last tick was 2.73. Let's go daily view. Not good. Momentum going in the wrong direction. I think right now, very short term, XRP prices are probably going to come down lower. I would just be dollar cost averaging in here. We do it every month. In fact, the money came out of my account today, went into Bitcoin, just Bitcoin. I didn't do XRP today. So we'll continue the dollar cost averaging here and buy on weakness. All right, let's see what I have here. Michael Anthony, I can't do Lyft. I have a potential conflict of interest there, so I'm not allowed to comment on that. I don't think it's appropriate. So I'm going to have to do a hard pass on that. I'm sure you'll understand. We want to maintain a very high ethical standard here. So unfortunately, I can't review that chart. SPY. If you have another one, throw it in there. I'll go over for you, pal. SPY. All right, so let's just do it the old-fashioned way, and let's draw some pictures. Okay, so the S&P 500 is in what you call an ascending wedge formation, and you're nearing the apex of that ascending wedge formation. Now, by no stretch of the imagination does that mean that we can't blow through this upper band and rally up to these resistance levels here. It'll just make for a more expensive stock market. But typically what happens here is that you'll break this lower band of support. And I want you to take note of something, and that is this. It's that last week we put in new all-time record highs on the S&P 500. The problem is we couldn't close there. So we've kind of stalled out on a closing basis where the highs have been over the past three, or where the closing price has been over the past 3 weeks. Really, it's starting to lose momentum. And let's bring up the stochastics. Volume has been okay on a weekly time frame. Let's bring up the stochastics. And you could see that I don't like this phrase overbought, oversold when you're talking about stochastics, because you could stay overbought, oversold for extended periods of time. So simply because the lines on Stokes are trading above 80 doesn't mean you short SPY. I can't stand that way of thinking. So I'm very passionate about that. I love using the Stokes, but for different reasons. I want to see lower highs, lower lows, and many times you'll get that before you get a break in price. We're not there yet. Let's bring up RSI for a moment. Let's see what that's looking like. They're both still quite strong. You're not seeing that big breakdown yet. Right? We're still holding trend on RSI. Stokes may be flirting with a rollover here, but not quite yet. Price, it's not decided whether or not it's going to break one way or the other yet, but it's going to. It cannot stay in this wedge formation, ascending triangle formation, ascending, whatever the hell you want to call it cupcakes, whatever pattern label you want to throw on it. It can't stay here forever. Generally, this doesn't end well. The however is that we've done this before. We broke trend back here. Back in July. What did we do? We rallied. So is this an effort to try to recapture a prior trend? Maybe, but to me, this looks like it's a check back, and it's an effort to try to reestablish itself, reassert itself. That momentum that it had lost back here. It was a seasonally favorable period of time. I think that ultimately this is going to break south. Now, where do I see is at the end of the year? I think that we're probably going to correct in September, but in October into the end of the year, folks, we can lie to ourselves all we want. But if we take a look at history going back 33 years, after September ends, the Santa Claus rally begins, and then the new year is probably when, if we get a real serious break in the market, that's when it's going to occur. So I don't want to delude anybody into thinking that simply because by virtue of the fact that I think that we're going to break south here. It doesn't mean we go straight down. It just means that we begin sending signals to traders that, you know what, looks like this bull rally is coming under a lot of pressure. Break lower, rally back into the Christmas holidays, and then potentially roll over into 2026. What else do we have here? Neighbor for Bonnie Bean. Now, this is one that one of my radar. I think I definitely talked about this. Got to have my line set up here. Uh, I'm bullish on the energy plays. This is looking really good. Since we last spoke about it, we broke out the week of August the 18th. No retest yet. We might still get that of this breakout point, but I'm a buyer here because I like it. All comes down to really one thing with me. If you're bullish, you want higher lows. Do we have that? Yes. Bullish. Momentum on the rise. Volume could have been better last week. Daily view, looking good here. I don't view this as a short-term swing trade. I would chalk this up to being an investment, not a short-term swing trade. And if memory serves, NBR pays a pretty good dividend as well. Let me validate that so I'm not giving out bad information. No, it wasn't. It wasn't. They hardly have a yield. That's a different stock I was thinking about. So I'm glad I checked. So bullish on neighbor. We did XRP. I think that's about it. All right. Let's check back in with the rest of the market, see how it is settling in here. I'm going to go to a 15-minute chart now. E-minis are still trading up. Just fractionally. NQ, really quiet night here. Not much happening here. Let's go to the gold markets. Gold still holding gains, consolidating very, very tightly. In fact, you have a nice Bollinger Band squeeze that's setting up here. Looks like they're going to take this up. This is a 15-minute chart. I think they're going to take out the highs probably tonight. As for silver, we're still up 2.24%. We're off those highs, flirting with holding the 21-period EMA on a 15-minute time frame. Crude prices, they're off of their high, but still positive. I think we have a last-minute request. Michael Anthony, HRL. Let's take a look from Michael Anthony because I couldn't do lift. HRL. My guess is that we had earnings that came out here. I want to drill down further here. Let's go quarterly view. I want to check out the revenue growth. Their revenues are coming under pressure. See that downtrend there, Michael? And it's reflected in the share price. Now, here's the problem for HRL. Now, you asked a question. Let me see. I want to make sure I answer it directly. Michael asked, can go up from the dip. I don't see it. I see this going down further, Michael. If you're gonna look to buy the dip, you're gonna want to do it when you have much lighter down volume than what you're seeing right now, because you're seeing institutional distribution. You don't want to get in front of these guys. They're too big. They'll destroy you, literally. Your RSI, relative strength, basically your momentum indicators are saying avoid like the plague. And the fact that we broke this support level here at 29.49, that's a major, major problem. We're going lower. Now, that doesn't mean that they won't try to rally, just like we sort of spoke about with SPY. You can get breakdowns, but many, many times, more often than not, you'll get a rally back in an effort to try to recapture. Those are just traders, usually retail traders, trying to keep the hope alive, and they get hammered. So next stop for Hormel looks like it's going to be at about $19 per share. If that fails, it's coming down to $9.90. Quite a bit of a haircut here. So, price matters, right? So valuations matter, price matters, and the fundamentals here are not boding well. There's no reason to get in front of this. The technicals are poor, fundamentals are not looking great. So I would avoid this one. And that, my friends, I think is about it. Pam, are you short or long bias? I am short bias, not necessarily on the technicals yet. I'm more biased on the market from a valuation standpoint and seasonality standpoint. I don't see the headlines that are coming out about the economy as being good. I think the Federal Reserve is kind of boxed in. And I think that ultimately, while it's the bulls are going to take this announcement or this expectation that the Federal Reserve is going to cut rates, they're going to treat that as bullish. That's all well and good. But I don't think that ultimately you're going to get a really big response by bulls to the Fed until such time as they begin quantitative easing, going in and buying longer term debt. Because I think that just by virtue of here, where is that? I don't think I brought it up. I thought I had. I'm going to show you a chart. I had mentioned it earlier. You're welcome, Jody. Have a great night now. Let me go to Twitter. I just tweeted this out, or X. I still can't get used to that name change. So the Mortgage Bankers Association came out with mortgage rate expectations, 30-year mortgages. So we're in the final month of Q3 now. And the current 30-year mortgage rate is 6.7. They're projecting 6.6 to 6.5. And then that's pretty much as far as the eye could see. So really, even though the Federal Reserve is going to cut short-term yields, they don't expect a decline of any measure on longer-term debt, meaning 30-year debt, 10-year debt, 20-year debt. So that's a problem for the Federal Reserve. It's a problem for the administration. And whoever takes over Fed Chair Powell's position, they're going to have to go to quantitative easing. The only way to bring down these yields is for the Federal Reserve to be the buyer of last resort and to buy this debt. And they've done it plenty of times before. I show this chart all the time. Here was the financial crisis when they went and they started buying up debt. Here was COVID, and we even had a little spike here when you had the regional bank crisis back in spring of 2023. And ever since then, what have they been doing? Rolling off debt. What have long-term yields done ever since they cut rates by 100 basis points beginning 1 year ago today? Longer-term yields have gone up, not down, up. I think it's simply that we have a slowdown. The housing market is not where it needs to be. You're seeing prices come in certain areas, like I think Vegas is coming in. I know the Florida markets have come in quite a bit. So there's just not a tremendous amount of demand right now. But Buffett is in there buying up the home builders. So he's seeing some opportunity there on valuation, but it's going to take time for those plays to turn around. Will September weakness affect stocks like UNH? If so, then it may pull back to the 280s. All right, so that's a really good question. So I'm long of UNH. I'm long of CNC. If we do get a reaction by those names, I think it's only going to be, it's not going to be in line with the rest of the market. You have big buyers in there now, very, very strong hands that are buying up the stock. UNH pays a yield, unlike CNC. So I think that we're going to see, if we do get a pullback in the market, sure, we may get a pullback in UNH and the other names in that arena. I don't think by any stretch of the imagination anywhere near the level of the pullback on the overall market. Now, I think that there's a very good chance that you see value players move in and they begin to buy up UNH stock, even though the overall market's pulling back, because you saw that with Staples at the beginning of the year when the markets came under pressure. Money didn't go into bonds, didn't go into TLT. It went into the XLP, the Staples. And you could view the healthcare stocks as being a proxy for the Staples as well. They're cheap. So I don't think that they're going to get impacted as much. You never know. But if it comes back down to 280, I'm a buyer all day long of UNH. Scott McCullough, check out the open. It's gaining traction. All right, let's bring it up. We got a couple minutes left here. Is that open table? I haven't looked at that stock in a long time. Oh, no, it's not. What is this? All right, open. Strong revenue growth. He's got a point. I like it. Good breakout above multiple resistance levels. Now it's consolidating. Probably will bounce around here for a couple of more weeks, but it looks like it wants to go up. Bullish. How about natural gas and natural gas stocks? We own FLNG. We bought it a long time ago. And this pays us. We bought it when it was yielding about 13%. That yield has come in a little bit because price has gone up. I'm extremely bullish on the liquefied natural gas names, because you take a look at this chart, monthly view, and you had a major breakout last month out of this downtrend channel. So I'm very bullish on FLNG, LNG. I like those names. Natural gas, there's so much supply out there. It's very difficult to trade natural gas. We own a position as a swing trade. That's about it. This is more of an investment to us. So I'm going to own. I've owned this for, it's got to be over a year now. So it's an investment. It falls into that category of trades for us. Whereas, we own Boyle, and we're doing okay with it. It's stair-stepping up higher, and there's probably more upside here, but I don't see it becoming an investment anytime soon, unless, of course, it starts making a massive, let's check it out. Maybe it is massive cup with handle formation. Let's just bring up UNG. Boyle is so volatile. It doesn't look good on a chart. You're not. It's sloppy. Where I would be bullish on natural gas is if we were to close above 25.68 on UNG. I would not use Boyle as the proxy. I would look at UNG or the /NG futures ticker. You want to see higher highs, and that's what's been eluding us. We continue to get short covering rallies, lower highs, lower lows. We need to see a breakout above 25.68. If we get that, I might hold on to Boyle and maybe become a longer-term trade. But right now, we're hopefully building a base on natural gas. There's just so much supply out there. It's kind of a problem it's hard to get out of its own way. All right, guys. Thank you all for being here. Like, subscribe. You know the deal. And don't forget about that 50% off sale over at TrendSpider. I posted the link in the chat area. It's also below if you're watching this on YouTube, above on Twitter, Facebook, and get that 50% off. And we have, if the Qs do break down, I have a link below. It's free. Sign up for it, of all the key support levels that I'm looking at, because we're short the Qs on the triple Qs. So check it out. It's free, and I'll update it from time to time. Everybody have a profitable trading week. Happy Labor Day. Be well.